So we're going to be going over the vente partners lease problem. It's going to have both the lessor and the leasee journal entries. So let's get started. Vente partners signed a non-cancelable lease on January 1st, 2012 with Equipment Rentals. So that Equipment Rentals is the lessor and Vente Partners is the lessee. There's going to be 5 annual payments. They're going to be payable on the first day of the year. So that would make an annuity due. All right, and the first payment is going to be at signing. Okay, and at the end of the 5th year, there's going to be a guaranteed residual of $16,000. That's not the same as a bargain purchase, but it will be a final payment that must be included in the present value of the minimum lease payments. Okay, the implicit rate is not given. We're going to have to solve for that. Vente Partners believes the salvage will be $20,000 at the end of the lease because their volume is low, and so they think it's going to be greater than the $16,000, and they could use a different salvage, but the final payment will be $16,000. Okay, the list price is this $41,000, meaning that we cannot capitalize this lease for greater than the list price. And then the lessors incurred some direct costs in obtaining the lease, and so those are spread straight line over the term of the lease. So to solve for the interest rate, we're going to set up the cash flows here and solve for the internal rate of return using Excel. So at the very beginning, there's going to be the cost fair value of the asset, so that's going to be a minus. So the fair value was this $41,650.27, and that's going to be offset by the first payment coming in from the lessee. So that, well, do we have a typo in here? We certainly do. Let's fix that. There we go. All right, and then there's going to be inflows of this $650 here for 4 more periods. The first one is at signing, so it nets against the cost of the asset for the lessor to obtain it, or the fair value that they're giving up. And then there's the $16,000 at the end. So this is sort of the cash flow done in an array without missing any sales, no sales in between, because Excel counts that as a time period. Okay, so we go up here to the function, we go for IRR, and we highlight the values, hit enter, put in a guess. I always do 0.1. You can put whatever you want in there. All right, 6% is what we need. So we have solved for that. And now we can do the amortization schedule, and then we can begin to do the journal entries for the various parties. So the balance here is going to be the present value of all the future payments. So let's set that up. The rate is the 6%. The number of periods is the 5. The payments are going to be put in as a minus, so that what's returned is a plus. Excel uses outflows and inflows, and it knows that if there's an inflow at the beginning, there's got to be outflows later, or if there's an inflow at the beginning, there's got to be payments later. So if you want a negative number, you have to put them in as a positive. That takes some getting used to. Oops, wait a minute, I didn't do the annuity due. Let's pull that back up. So annuity due is a 1. And if you leave it blank or a 0, that's an ordinary annuity. Okay, and notice how that matches the fair value. So that's giving us a full 6% return. Okay, good. Everything looks good there. So the payment is going to be that. We can anchor that and then copy that down 5 times. And then the final payment will be the $16,000. There'll be no interest on the first payment because it's due at signing. And so that full payment is going to reduce the lease obligation down. Now there's going to be interest starting the 2nd year times the interest rate. All right, let's anchor that baby down by hitting F4 if you happen to be using a PC. If you're using a Mac, you have to type in the $signs in front of the D and in front of the 2 if you're mimicking this here. And so let's copy this down, make sure it goes down to 0. And it does. Okay, so there's our amortization schedule that we can use in making the journal entries. So let's look at the journal entries for the lessor. what's going to be receivable. What's going to be receivable is the present value of the future minimum lease payments. The sales will equal that. Now, the cost of goods sold is going to be their original cost, which they told you was the $24,000, so that's coming out of inventory. Plus, they had those original direct costs. So I said originally we were going to spread this over the lease, which would be true for a direct financing type lease, but I'd forgotten this was a sales type lease. And for a sales type lease, you expense that at the beginning in cost of goods sold. So let me correct myself on that one. All right, so then you're going to immediately get your first payment at signing, and that's going to reduce your receivable. So those are the journal entries for the lessor at signing. All right, so now that's January 1st of 2012. At the end of that year, the payment is not due yet, but you've got to accrue in the interest revenue because it's been earned during the year. So we're going to accrue in that $2,100 and show it as revenue. Now, when the payment comes in, we can put the whole payment against that lease receivable because we debited the lease receivable here. You could have also done interest receivable here. It would change your entry a little bit here. Either one is okay. So if you like one better than the other, they will both give you the same ending. The net of these two will still give you the same ending receivable, which is correct. All right, and then of course at the end of the 2013, you will again have to accrue in some interest. Again, you can accrue this to interest receivable if you prefer. If you do that, then this entry here, you'll have to split this between the lease receivable and interest receivable to clear out your interest receivable January 1st. Okay, so those are the entries for your lessor. Now let's do the lessee. So the lessee is also going to have a piece of equipment and an obligation equal to it. And it's also going to reduce the obligation by the full payment because there's no interest at signing on that first payment. All right, now at the end of the first year, they're going to have depreciation or amortization expense for this asset. Now the equipment's been capitalized at this, and we have a presumed salvage that they want to use of $20,000. Even though the required minimum salvage is $16,000, they can use something different. Now, they're going to divide by the lease term because they didn't toggle in at a transfer of title or bargain purchase. This must have been a capital asset because the present value of the minimum lease payments was 100% of the fair value. So we're going to use the lease term, which is 5 years. So I took the cost of the asset minus the salvage over the 5-year term. All right. Okay, and then the interest expense kind of mirrors what the lessor is doing. I'm adding this to the lease obligation. You could also put it in interest payable. That's up to you. Either one gets you back to, and then when you make the payment the next day, the net of these two is making the obligation go down. So if you put this in an interest payable, then you would remove the interest payable and just show the net 455027 coming off of the lease obligation. And that's okay too. All right, and the next year, the amortization expense is the same. It's just year 2 of straight line depreciation. The interest expense will be the next one on the amortization schedule, and so forth. All right, so those are the patterned journal entries, and you could probably keep going and do the next 3 right off this amortization schedule because they start getting repetitive. They ask about what will the asset look like at the end of year 2014. So the original cost of the asset is still the 41, and the accumulated amortization at the end of 14. So that would be amortization for 12 and for 13 and for 14. So that's going to be the amortization 3 times. So there we go. Notice this doesn't have to mirror what the obligation is doing. This is just straight line depreciation on the asset that was deemed to have been purchased. All right. And now what about in the liability section? So now we want the current portion of the lease obligation. All right, so the current portion of the lease is going to be the principal portion that they're going to pay in 2015. So let's see, what's that going to be? That's the portion of the principal portion that's going to be paid in the next year. The interest payable is going to be what's going to be accrued in 12/31/14. All right, and then the non-current portion of the debt is going to be the total debt less the current portion. So where's the total debt at the end of 14 minus the current portion? All right, so that's the liability and the asset presentation at the end of 2014. All right, so let's do that same thing now for the lessor. What are they going to have on their balance sheet in 2014? All right, so they're going to have the current portion of the lease receivable, which is going to be the portion that they're going to get in 2015. The lease receivable non-current is going to be what's on the balance sheet minus the piece that's in current. And then the interest receivable that they've accrued in at the end of 14, that's going to be coming in the next day, actually, right? Okay, so now what about the journal entries at the very end of the lease? They say here to assume that they sold it on the last day of the lease for $19,000. All right, so $19,000 is coming in as cash. They've got to remove the asset from the books. All right, so they've got to remove the leased vehicle that was put in there at cost. And then what are they going to have for accumulated amortization at the end of all those years? So they will have done that 5 times. So amortization expense times 5. All right, so now what did they have, a gain or loss? This probably tips you off because I've already got that written in. So what is the amount of the loss? It would be what makes this entry balance. Okay. And then, of course, they still have one more payment. They have to pay that final payment to the lessor. That final payment that's here. They still have to make that to the landlord, to the owner. All right, now what about the owner? What kind of entry are they going to make? Or they're getting their final payment, which will reduce and clear out and zero out their lease receivable. And they don't have any transaction here for the sale of the asset for $19,000. So then at the very end here, they want you to make the journal entry if the lease is cancelable. Why are they making that nuance change there? And that's because they want you to recognize that if you can cancel this lease anytime, it's an operating lease. And so that would just be that when the payments are made, you would have rent expense or rent income equal to the payments, and you wouldn't be recording assets or obligations at all. Great. We're done with this one.